Welcome back to Behavioral Finance and FinTech. I'm Andy Kim. And then last time we talked about the air pollution effect on our disposition effect, loss aversion, all these kind of things, especially using the Chinese data. I hope my Chinese students don't take it personal, right? 我有很多的中国朋友 and 我爱中国 right? And then, personally, I like you guys so much. But this is what's happening in the country level. Country level is country level, official one. Personal level is a separate one. So don't worry about, any other biases that I might have or anything like that. I was educated enough about this fairness kind of things and diversity. I have to, cherish those things, right? I do. And I can sing Chinese songs as well, if you request anything. But this is what's going on. Okay, we have to be rational in discussing this kind of issues, right? So that's that. The next one is about sports sentiment and its effect on stock price. And we're going to talk about music sentiment as well. A very exciting one. Well, what's this picture about? This is 2002 when you guys were born. No, World Cup soccer game, right? In Korea as well as in Japan. Okay, and then this one was in the number 3 and number 4 match. South Korea was very lucky, and we got really excited about it. And then it says, "Dreams come true. Dreams will come true." Our dream of becoming one of the top 4, right? And this was a match with Turkey, our brother country. Yes, and then. During this kind of, by the way, how did Korea do in these 3-4 matches? If you remember, we lost. Very depressing. Okay. But anyway, World Cup soccer game, the people get naturally excited about their own countries and national pride gets over there, right? But the thing is, once they lose it, people get so much disappointed and they do what? This kind of negative sentiment or the mood, right? Does that affect the stock price? And the answer is yes, it does. Who tested that? Alex Edmans and then Garcia and Noor Lee. Those are, Alex Edmans is a genius professor at London Business School. And then they went through a big data of sports game matches all around the world, right? For decades and decades. World Cup soccer game, Olympic games, and international cricket games, and rugby games, and basketball games, and just name it. And then what they found is that once your country loses, well, that depressing mood affects your stock index level the next day by about 38 basis points. This is big enough of magnitude after thinking about your transaction cost. So you may have some money-making opportunity by just watching television sports games. For example, Russian World Cup 2018, right? Surprisingly, anybody from Germany, right? Eat your heart out! Yeah, I know. But nothing personal, don't worry. Korea won Germany in that soccer game, which was total surprise to everybody. Not just for Germany, but for Korean people as well. How could we win, right? And then, 2-0. Yes, adding salt to your wound. And then the next day, the DAX index of Germany, Frankfurt, index level went down by 1.6 percentage point. I remember there was not much of a important news in Germany other than this one. Okay, this sports sentiment affect your stock index level and the whole average level the next day, and then subsequently it reverses back. Okay, because this is totally psychological one, not a fundamental one. Some of you may wonder, isn't that something about the, your fundamental cash flow expectation plunges down with, if you were, Adidas kind of companies. Well, DAX index, Adidas is just one of the element. And the thing is, Volkswagen, Porsche, or they kind of guys, right? Would they be ever affected by this kind of sentiment? They keep on producing and people keep on buying Porsche everywhere in the world anyway. BMW, by Riche Motorenwerke, right? People buy it, doesn't get affected by this, right? It's total psychology, right? That's what they find. Recently, Alex Edmonds, right, published another paper, a genius paper again, about music sentiment, pop music sentiment, and the stock return, London Business School, right? What did he do? Well, music is a common language around the world, right? So what these guys did was, well, let's quantify the music sentiment. But how do we do that? Let's use Spotify, which is our application, apps available on your cell phone, right? And then if you go there in the website, they provide this kind of valence scoring mechanism so you can use it, right? So upload your music and then it spits out the valence score, which means 깨방정 score, like how much 신나 is it, kind of a upbeat move, right? Versus downward, like funeral kind of mood, right? So they did it for 40 different countries, and then day by day from 2017 to 2020, day by day, each country must have top 200 songs over there, and then which means 85,000 pieces of music over there, and then people stream those things to listen to, and then that gives them 500 billion streaming record. And out of it, okay, what they found is that one standard deviation higher valence score, 깨방정, and then the stock price index, the average index, goes up by 8 basis points in that week. And then the subsequent week, what happens? It reverses back to original, because this is total psychology, okay? And then the concurrent week up, and then the reversal back in the subsequent week. Very interesting finding. And then some of you may wonder, what is the most upbeat music in that database, right? Well, it turns out it is September of, the Earth, Wind, and Fire. Let me just play a little bit about it. Yes, this is it. Yes, this is it. So I should return back over here, right? So that's September, just passed. Now it's October, right? And then average valence score by the country. They show it by the continent. You see Latin America. Anybody from Latin America, right? Welcome, right? You guys have the most upbeat musics, on average. Asia, we need some help, right? We are all, serious musics over there. Somewhere in between, you can see country by country differences over here. Quite interesting. One thing I don't like about this paper is that they don't have Korea data. Why is that the case? Because Korea only started to allow Spotify to work in 2021. That's this year. So they don't have data about Korea. The thing is, K-pop is so popular these days all around this world. Why do they omit Korea? All right? But it just happened that way. Anyway, so it was fun to see this paper. And then sentiment index, right, is a one. We're going to see it in the, let's see. Right, sentiment index is the idea brought up by Baker and Vergler in the Journal of Finance 2006 paper. Now, how do we quantify this sentiment? Has been an issue. Musical sentiment, well, that's a short run one. Sports sentiment, that's daily one, even shorter. Sunlight and that kind of things, that's kind of, sentiment, but we call it mood over there, right? All these things. But the sentiment, what they try to capture over here is like the degree of bubble and crash kind of things, right? Getting away from the fundamentals, right? In the mid-term run, right? So how do we quantify that? Well, they say, let me get to this part over here. Yes. Now, how do they estimate or measure this degree of sentiment? Well, they use principal component analysis technique, which is another machine learning or AI technique, right? Supposedly. I mean, finance has been quantitative, has been using engineering technique anyway, ever since, right? What is non-quantitative finance anyway? Nothing, right? No surprise. Well, I know. Anyway, so what is the principal component analysis idea? Well, in order to capture something called sentiment index, right? Let's bring, a handful of variables that everybody agrees, most people agrees, those variables are correlated with what we call the bubble and crash, right? 6 variables. Well, they propose these 6 variables, which is, first of all, closed-end fund discount. Second, share turnover, how many, and then number and average first-day returns on IPOs. These are number of IPOs and then average first-day IPOs, the 2 different elements, right? And then equity share in new issues, right? And then lastly, dividend premium, okay? Those 6 variables they suggest. So one by one, let's go, right? Closed-end fund discount. What is that? Well, in mutual fund industry, you have 2 different kinds of mutual fund, which is closed-end fund and then open-end fund, right? The closed-end fund is like once you put your money in, you cannot redeem yourself, right? Redemption. You have to wait until the end. So it's closed for you, okay? You cannot get your money out, but the stock itself is being traded in the market. And then the stock of this mutual fund, right? You can see the market price of the mutual fund day by day. The thing is the price of this fund, right? Price of this fund equal to the net asset value of it, considering all the holdings of this mutual fund, right? So NAV of this closed-end fund has to be equal to NAV of the closed-end fund has to be equal to the price of it, but it does not happen that way. There's a discount that you find. And this discount, the degree of discrepancy, okay, minus, right, the magnitude, is much bigger during the crash time, and then it's not that big during your boom time or bubble time, or it gets even premium, okay, during the bubble time. And if the market is efficient, why should this happen? That's a big mystery. One of the evidences of the inefficient market, And then, so closed-end fund discount. Let's use it as a proxy for sentiment or the bubbleness, right? People agree with that. The second one is about the share turnover, which means trading volume, how many people buy and sell those stocks day by day. The thing is, last year, 2020, many of you jumped into the stock market and then traded. Why? Because it was in the bubble. Everybody was like excited about buying it, selling it, right? This year, not many, okay? And then during the crash time, how dare you? Wow. So that's trading volume tells a lot about this, goes together with this bubbleness of the stock market. Number 3 and 4, IPOs. Yes, in Korea as well as in the United States, last year and this year until now, IPO, it was a boom time for IPO industry, initial public offering. Why is that the case? This goes together with the next point, equity share in new issues. What is that? Well, this shows the capital or the money raised in equity market as opposed to debt market. If you are the CFO, which one would you go as a source of capital? Debt versus equity during your stock market boom time? Of course, equity market, because it's in the bubble, which means the cost of equity is extremely small. Cost of capital is very small over there compared to the cost of capital in your debt market. So it's optimal for you to go there in equity and issue equity either as a IPO or as a seasoned equity offering, SEO, right? 유상증자 kind of things. So those are there. And then during this boom time, not only the frequency of IPO is big, but also the first day return of the IPO is huge. In Korea, we have what? 따상 or 따상상 kind of things. 따상상상상상. Right? What is that? We have price limit day by day, 30% or something. Okay? So that's why we have to wait one more day. If it hits the ceiling, like that. But in the United States, you don't wait. It's like one day, 10 times. Wow. And that magnitude has to do with the degree of bubble, the sentiment. People agree with that. So they used it as a proxy. The last proxy is a dividend premium. What is that about? You have growth stocks, tech stocks that don't pay dividends versus POSCO kind of value stocks or Coca-Cola kind of value stocks that has long history and established factories and network of salespeople so that you can afford to pay dividends. And then those dividends, value stocks pay dividends, and then usually this kind of dividend paying stocks are discounted during the bubble time because people go for this, growth stocks. It's not sexy over there. We go for this one, But during the crash time, what happens? They run for quality and they run for these value stocks. The growth stocks plunges down and the dividend stocks go up. So that's dividend premium. And it goes together with the bubbleness and crashness in reverse order, right? People agree with that. So these 6 variables, they use it, lump it in, and then use, the principal component analysis mechanism. I don't teach you about this mechanism, but you must be learning it somewhere in the machine learning kind of classes, right? The idea is to extract commonality among these proxies, 6 proxies. Use, through principal component analysis, extracting the eigenvector, the 고유 vector kind of things that explains the variations of these things to the best. Okay, best explains the variation together. Eigenvectors. So that's sentiment index, right? They label this guy as sentiment index because the researchers agree that these 6 are really related to the sentiment that we want to capture. So the idea is once you capture the sentiment like this, the time series graph that you see are the 6 proxies movement over the sample period. And then the last one panel is the time series graph of the sentiment index they drew out of it. Now what? And then visually you can agree that, the sentiment index was very high during what we call a boom time, and then it's very low during the period we call crash time. And people agree, okay, that's happening. So then once you have this kind of index, what do? Develop your investment strategy. What kind of strategy? I told you before. What stocks will be more vulnerable to this kind of index, sentiment? Small stocks rather than big stocks. So what do? Well, they sort them into according to the size of the companies, 1 to 10, right? Bottom 10 percentile in terms of size, and then top 10 percentile in terms of size. So different size group, and then what they also observe and what they test is the average return. Okay, let me read this one. 10 portfolios according to the NYSE breakpoints from firm size, and the solid bars are the returns following positive sentiment period. Solid bars, and then the clear bar, right? The white ones are the returns, average returns following the negative sentiment period, so crash time. So white ones are the ones when you start to buy and hold it, okay, for the future, when the stock market is in a crisis time, you buy small stocks, subsequently you earn much better return than when you do the same for the big stocks. Small stock is much more vulnerable to the sentiment. That's what they find. So trading profit seem to happen. They find abnormal returns with this one. Yeah. they find the dashed line is the average across, between these two, right? Dashed lines. And the solid line is the difference. Yeah. And then, what is important is about the finding that the smaller stocks are more vulnerable to sentiment than the big stocks, right? Why is that the case? Because big stocks, they are priced rationally, which means that all the information about these big stocks like Samsung Electronics, or in the US, like ExxonMobil kind of companies, or Apple, billion or millions and millions of people watch that stock every day. Okay, so it gets priced, the information gets priced instantaneously anyway, but nobody knows stocks, right? They are not priced rationally like that, not efficiently. So that's why they are more subject to this sentiment. You have more profit-taking opportunity, right? Well, mood and sentiment, well, essentially they are the same concept, but the researchers on sentiment used sentiment proxies that are subject to further arguments. For example, those 6 proxies, are they really exogenous from the system, exogenous to the system? Exogenous means like what? Is it determined outside, totally outside the financial market? For example, thunder, pew, or thunderbolting, boom. That's totally exogenous event. The weather, right? Of course, nowadays, some countries started to control the weather themselves, but during these periods, right? You cannot control the weather, right? But IPOs, number of IPOs, or mutual fund discount, closed-end fund discount, and all these kind of proxies, are they exogenously determined like thunder? And the answer is no. The thing is, it's determined within the system. We call it endogeneity problem. And then IPOs, closed-end fund discount, right? Stock trading volume and liquidity, all these kind of things are going together with it. So even though we agree that those proxies move together with the bubbleness and crashness, part of it is still explainable by economic fundamentals and risk, right? And cash flow kind of things. Is this really psychology or economic fundamentals, right? IPOs, number of IPOs, and frequency of IPOs. Well, is it purely psychological? Or is it because of innovation going on? At random time, economy experiences explosion of innovation. Okay, explosion of innovation. For example, the medical industry over the last year, right? Random time COVID-19 shock happened, right? Exogenously. Bam! Out of nowhere, out in the blue. And then it gave us more reason to innovate in the medical industry, to come up with all kinds of vaccines or kind of a cure medicines kind of things. Had to ramp up, yeah? Exogenous shock. And then accordingly, the medical industry boomed, mRNA kind of things, right? And then vaccines. Not only that, all those patents, and then not only those vaccines for this COVID-19, but there must be some spillover effect to other industries. Naturally, that will lead to more venture companies coming up, and then it will naturally incur more IPOs. And then those IPO frequency takes up. Not because of the psychology, but because of the economic fundamentals. So the rational economist can still argue that sentiment index doesn't seem like really a psychology. Hide and seek problem happens. Researchers on mood use variables that are down and out, exogenous. There's no room for reverse causality. Okay? Now, so that's a comparison of these two. And the next video, we're going to go into a new measure of sentiment using text-based analysis or communication-based analysis. Okay, so that's going to be a very interesting one. So wait for that one. Thanks for watching. Bye.